Welcome to Subramani. I'm going to give you a few tips on investing. Okay. Now, many people are giving tips. There are many videos which are giving tips. They'll tell you what tip to buy, what to sell. I have no tips on what to buy and what to sell. I see a lot of nonsense happening in the market. I'll just keep my eyes shut. But let me start you, if you're a young investor, let me just tell you some of these things. The first thing, which is very, very obvious, but not many people do it, is start early. Every person I meet in life has a regret that I wish I had started earlier. I wish I had met a person like you as my father who invested. My family did not invest in equity. My family was only saving money. We never invested. All these I keep hearing. But please understand, your father or mother or your grandparents would not have had perhaps the guts to invest because they had a small amount of money and they did not know what will happen to the markets, right? Market was not considered to be fashionable even 30 years back or 40 years back, right? Yes, certain communities did, Gujaratis did, Marwadis did, but it was not very common, right? In South and East, even in Maharashtra, not too many people invested. But yes, you know it, so start early. Let's say you're 18 years of age, 19 years of age, you can invest 500 rupees per month. Just start. Do an SIP in a small fund, in any fund, doesn't matter, but start, make that start. It is very important. Does not matter what rate of return you get. Right now your corpus is too small, but just make the start. So start as young as possible. If you're a typical Guju, your parents may have started an SIP for you the minute you were born, right? On day one, they would have invested in your name, and by the time you're 15 or 18, your PPF would be bulging with at least $1 million rupees, right? So those things would have happened. If they have not done it, it is for you to start now. So which is the best time to start investing? It was 100 years ago. Your great grandfather should have done it. 70 years ago, your grandfather should have done it. Or 50 years ago, your father should have done it. Since they did not do it, or since they did not do enough, it is for you to do it now. So just you don't have to be like a Warren Buffett or a Charlie Munger, but both of them keep saying this, right? Start early. Starting early is very important. So just make a start. Don't wait for that big 5,000 rupee or a 10,000 rupee. If you can spare only 500, just go start an SIP for 500. Just make that start. It is very important. Don't keep on waiting for some big thing to happen. It does not really, it may not happen, right? Another thing which I like to do, which I keep saying, I do not know how many people do it, is keep investing, right? Does not matter whether the market is up, market is down, does not really matter. Either as an SIP or even when you have, let's say you have a portfolio of 10 lakhs of rupees. It looks like a big amount to you because you have, you have every rupee that you have put, maybe you put 6 lakhs, 7 lakhs, which has become 10 lakhs. It looks like a big amount. Yes, it is a big amount for you. Now suddenly somebody gives you 5 lakhs or 3 lakhs. You get a bonus or something happens. Everybody will advise you that do it as an SIP because it's a big amount. The thing is, yes, you can do it as a SIP, but if you're putting into 4 funds, putting into those 4 funds equally at on 0.1 or 0.0 does not matter at all, because you are going to be investing for a long period of time. If you are going to invest for a long period of time, it does not matter whether you do an SIP or you do a lump sum. The only reason you do an SIP is to reduce the impact of a big fall as soon as you invest. Like you invested on the 1st of the month, by the 5th of the month the market is down by 20%. Yes, you can lose a big amount of money. However, if you understand that you can lose a big amount of money immediately, but the market will recover and you have the ability to sit tight, then there is no harm. The lump sum will almost always give you a better return than as SIP over 20 years. So if you can invest a lump sum and then do your SIP also, because you're investing through an SIP simply because you don't have money. You don't have 25 lakhs to invest today. Maybe you're putting 5,000 per month or you're putting 10,000 per month, but you don't have 25 lakhs. Now suddenly if you get 25 lakhs, put into the same assets in which you have been putting, right? You have a portfolio which could have a mid cap, large cap, gold, cash or liquid fund, whatever, in exactly the same proportion which you have. Just go and dump the money in the same ratio. It won't really hurt you. Historically, the market has gone up more than it has gone down. So to make the best use of this long-term trend, the best thing you can do is start investing early and just invest as aggressively as possible. Don't wait and say, oh, I will start after 2 months, after 3 months. Just start, right? It is the first step could be the hardest step to take, and the second step, which is living within your means. Only then you will have a surplus. These are two very easy to say but very difficult thing to achieve. You also understand that the returns are got not by timing the market but by spending more time in the market. So if you have 5 lakhs to invest for 20 years, you invest it today, which means your 5 lakhs is going to remain invested for 20 years. That is a crore of rupees, right? Impact, effectively it's like a crore of rupees. I'm not saying it is a crore, but if this 5 lakhs were to be invested every month as 5,000 rupees, it's going to take you a lot of time. It's going to take you 100 months, which means 8 years. So obviously the money which you invest last would have got no return if you look at for an 8-year period. Then you have to only look for a 4-year period. You are much better off just putting the whole money in the same ratio as the funds that you hold. If you have made those choices sensibly, that's the thing to do. Of course, in the US, people invest through 401k plans. Even in India, people invest in PPF and things like that, but they don't stand a candle to equity investing. So, third thing is, first thing is start early. Second is keep buying, and which leads to time in the market will definitely beat the best timing in the market. Another important thing is to stay calm and stay invested during bad times. So, if you had removed your money in March 2020, I wouldn't have blamed you, simply because I know that you must have been very upset and scared, and therefore you removed the money. However, staying calm during that period would have been the best way to improve your return. So you have to stay calm and invest more during times of market volatility. This is easier said than done, but it is your call whether you want to create wealth or no, right? Another important thing is to know why you are investing. What you are doing, everybody knows that you are that you are going to be investing. You are going to do. Why are you investing? It can't be just because everybody tells you to invest that you are investing. You have to be very clear about the goals that you have. A number doesn't signify any great investing success, but the process of choosing which stock to buy or which fund to invest, etc. Right? So that really helps. It is defined by your ability to achieve the why while you're investing in the first place. So you have to know why you are investing before you before you understand what you're doing, right? Now it also brings us to another question of asset allocation. I'm personally not very keen about asset allocation. I can afford to keep 90% of my money in stocks, but you look at your personality and what you feel. Are you happy keeping all the money, say 90% in stocks, right, or 90% in shares? People don't do it. People are very wary. People are very scared. So check what is happening, and based on that you decide whether you're going right for whether you're going for all those kind of investments. Another important thing for most investors, not true perhaps for me, is diversify. Have your money in multiple assets, some large cap, some mid cap, some balance advantage fund, whatever. All that put together is your portfolio. So the loser's game is very simple. You're diversifying to reduce risk. You are going to protect each one of your investments, but still your asset allocation is done, and you put some money in debt, some in equity, some in foreign equity, some in liquid fund, whatever. You've created that huge portfolio. And that's one way to minimize losses at any point in time if you look at it, right? So that's it. Thank you.